Good morning, guys. So today we're going to go over just like an intro to options. If you guys want more information, Justin has a video on the Blaze website. This will just be like a quick overview just so you guys understand a little bit more when we're talking about stuff, and you'll be able to eventually start working with options if you like. So a few things to mention is there's much more risk with options. So when I say that, the total dollar value risk is lower, but the probability of losing all of your investment or 50% of your investment very quickly is a lot higher. So when we buy an option, generally you want to have a mentality that it's going to go to zero. Whereas stock, it doesn't move as quickly. But if you have a big drop in the underlying value of the stock you're trading, then the option, or conversely going up, if you have a put, then the price of the option can go to zero very quickly. So I highly recommend paper trading. So what that means is either just like writing down on paper which options you would want to buy, and then like track the price of it over a couple days or whatever, or a couple hours, whatever your time frame for trading is. That's what I'm going to be doing today here. So what I'm going to do, just for demonstration purposes, I'm going to buy one Amazon put and one call on each direction, and then we can watch what happens to the price. So right now we're at 176.80. So we're going to buy one call at 1,787.5. So we'll click on this. Oh, sorry, we'll just do it over here. So 187.57. Actually, you know what? I'm gonna go up a bit higher. I'll explain why in a second. Okay, so we're gonna do 1760 call, and then you trade these just like you would a stock. So you're just gonna go in. I'm gonna do a market buy just because it's not real money. I'm gonna hit buy, send the order, and then we're gonna go up to Actually, we'll go around 1800. Is that about the difference? 1600, 1800, 18. Do 1805. And then we'll do put, and then we'll buy that. So we'll buy one. Oh, that didn't go through, did it? A couple technical difficulties there. So in our portfolio here, we got one call and one put. So I'm gonna leave this open while I'm talking, and then you guys can watch what happens to the price, and you can just watch how fast these move. So Amazon is a really high, like a high dollar amount stock, so the options are gonna move a lot faster than if you're trading something like something around like the $20 or $30 range. The stock just moves way quicker. So that's why I like trading Tesla and Boeing and SPY, because they're a high dollar value. So when you get a percentage movement in the stock, the options are going to move a lot quicker. So they're good for trading if you're right, and really bad for trading if you're wrong. Okay, so what is an option? An option is it's basically a bet from one person to another person. That they know which direction the stock's going to go, or it's a way to hedge your portfolio. So some people will sell covered calls against their securities so that they're protecting themselves if the stock goes down, and then you can collect a little bit of premium. So people pay a premium in order to get the option from the other person. So one contract is equal to 100 shares. A put is a bet that the stock price is going to go down, so you get the right to sell the security at a certain price, and then a call is the opposite, where you get the option to buy the contract at a certain price. And they have a date stamped on them, which makes them a little more risky, because if you're wrong at the certain time, your option price could go to zero. So with a stock, you can hold on to that stock indefinitely if you want, and it could go back up. Whereas an option, if you're wrong at the certain time, it goes to zero and you get nothing for it. So what we mean is, so all these have a date on them. So The ones we just bought for Amazon were June 7th, I believe. Yeah, June 7th. So, how far away? We're 5 days away from that right now. This data is a bit delayed, so it's not going to be completely accurate. I think it's from Friday. So what that means is we are betting. So we have a bet that the stock price is going to be above or below these certain prices. So if you were actually trading this, you wouldn't buy one of each of these normally because you're probably not going to make too much money unless the market's super volatile and you can get the direction both, like you can get right both ways. But so that's what we're betting. So we have two separate bets going on here. And then the person who sold the contracts is betting or hedging their portfolio the opposite direction. So when we're watching the option chain and stuff like that, like you look and you see that there's a lot of open interest on, which I'm going to go through all that stuff in a second. So if there's a whole bunch of contracts open at a certain time frame, there's one person betting that the stock price is going to be, so we'll use calls for example. So say we're looking at 1,785. There's one person betting that the stock price is going to go above that, and then they're going to get to catch the difference from the calls. And then the person who sold the option contract originally is betting that the price is going to be below because they don't want to give their shares away. They just wanted to collect the premium and then keep their shares ideally. So that's why it's really hard to actually figure out what's happening because there's two people betting on this. So you don't know whoever has the biggest pocket. So we don't know if the price is going to be below that or above it. It's generally just an important level to be watching. And then when Justin goes through that max pain, that's when there's a lot of people getting hurt on both ends of the calls and the put side. So like not as many people are profiting. So that sometimes can act as a magnet, depending. Okay, so when I was talking about risk reward, so in order to buy 100 Amazon contracts, it's going to be a lot of money, like 170,000, I think, for 100 shares. It's going to be, we'll get the calculator out, can't math right now, times 100 shares. $178,500 for 100 contracts. Whereas we just bought 100 contracts of each for about $8,000 roughly. Yeah, we'll call it $8,000. So as you can see, we've already lost $270 on the call side, and we're profiting $20 on the put side. What else we got to go over? So yeah, in general, just expect that the option can go to zero. That way it's not as stressful because they literally move so fast. Like I've made a lot of money on options and I've lost quite a bit of money as well on certain days. So you just have to be prepared for that and have proper risk management measures in place. Again, strongly recommend paper trading before getting into real ones because you just don't appreciate how fast you can lose money until you start trading options. I also probably recommend trading something that doesn't move that fast. I normally, quote unquote, so like the S&P 500 or something like that. Maybe just playing around with one or two contracts on that, and then you can get used to how the stock moves in relation. So on this right hand side, we're going to go over the option chain and like how to read it. So the left side is calls, the right side is puts. We have the bid and the ask. This is the same as trading stocks. You just got to be careful because sometimes the spreads on options can get really big and you're multiplying that by 100. So if you're paying a difference on a lot of, like if you're buying 10 contracts or something and you're paying a 50-cent difference, that's $500. So you just want to be really careful with your bid and your asks. Ideally, you want to be getting your bid filled, but it depends on your time frame. So like when I day trade, I usually just hit market because if I'm right on the direction, I don't want to be paying an extra 30 or 40 cents higher on 10 contracts than I would be if I would try to get my limit filled. So generally, I use market orders. Whereas if you're doing a longer term option trade, so a few months out, then you're gonna probably want to do just get a limit fill because then you're getting the difference if you get a lower fill. Okay, so bid and ask. Oh, we just flipped over there. Volume is the volume per day. So that's sometimes something to watch because so if we're trading S&P or something and there's a whole pile of volume on the, I don't know, like the 275 put options or something, then like it's something to keep in mind that they might want to drive the price below that. Again, there's somebody who wants a price above that too, so you never really know. It's just it adds more information to your hypothesis of what's going to happen during the day. Open interest is the amount of contracts that haven't been settled, right here. So sometimes those numbers look really, really big. Like you'll see like 10, 20, 30,000 open interest at a certain price. So again, we don't know that somebody wants to either get that price above or below it, but it's just another number to keep in mind. So depends on who owns all those contracts, etc. So that's what open interest is. It's just the amount of open contracts at a certain level. So somebody's bought them and somebody's sold them. So you can expect even like kind of a magnet effect to that price, but we don't know if it's going to close above or below that. Next one here, implied volatility. This is the premium. So the premium is it's the kind of the risk that you're paying the option seller in order to give up the option. So nobody's going to give it up for $0 or else they're not going to make any money. So that's what it's part of the premium. These next three numbers all add up. So the implied volatility is a percentage which is the premium that they're paying on top. So sometimes like S&P contracts, when they're trading reasonably close to in the money, are going to be somewhere around like $1 or $2. But when we had that really choppy week a few weeks ago, they were trading at like $3, $3.50 for the exact same contract that you would have paid for the week before for the amount of difference. So that's kind of the premium associated with it. So people are willing to pay more because they expect more volatility. So this is usually tied to the VIX and all that kind of stuff. The next one here is the delta. The delta is the ratio that the option is going to change in relation to the stock price. So when I bought these the contracts over here, what I was looking for was I was trying to get a delta of closer to 0. So, excuse me. Sorry, not 0, closer to 1. Because when you get closer to 1, the underlying price is going to move dollar for dollar with the stock. So I was just trying to get it closer to $1 for demonstration purposes, whereas the ones that are pretty close to the actual trading price, they're only around a 0.5 or 0.6, which means you're going to get a half of a move in the option price for every $1. So just for demonstration purposes, I wanted to try and get it a bit more volatile for that. How can we can, there, the strikes up here. So if we open up all strikes, we can go and look what the delta was for the ones that we bought. Okay, so about 1960. Oh, sorry, 1760. No, I would have to go a lot lower. Anyways, so we got a 0.7 on the call side. So for every $1, we're going to get a 0.7 multiplication move in our option price. And then for the 1807 puts, 18075, right? Yeah, 18075, our delta would be about 0.7. So I was pretty close on like getting them at least comparable. So that's how you tell how much the option is going to move. So next we have the theta. So this is the time decay. So when Justin's talking about premium burning and that kind of thing on the options, he's talking about the theta decay. So this happens a lot quicker on like when you're close to expiration. So like on the Wednesday, Thursday, Friday the expiration date compared to like the Monday, or if you're a few weeks out, the effect's a lot smaller. So when they're trying to burn the theta, there's usually somebody who's sold the option contracts and they're trying to get to rebuy these contracts back at a lower price. So if they let the theta burn down, and then they can buy back the options that they sold for a cheaper price and then net the difference. So that's what happens when they're kind of pinning the price in the middle of the day on Friday, is what they're doing there. Or conversely, they're trying to drive it down, buy the calls cheaper, and then driving the price back up. So it's really, really hard to determine what they're actually trying to do, but we just have to use all the information and trying to get as best of a picture as we can. And Justin's really good at that, so that's how he's able to call out some of those closes sometimes. Okay, what else do we have to go over? So when I'm trading options, I go closer. I go close to in the money, depending on what I'm trading. So usually like a few dollars away or at the money, depending on which day it is. And then I either buy the closest to the closest Friday or the following Friday. So those are for like day trading, just because you get a lot of movement and the prices are cheaper. So like if you're trading some of these bigger companies and you're buying it a month out, it's going to cost it costs a fortune, because you're paying for the theta, which is the time value of risk from your option price. So you'll be paying sometimes $1,000 per contract, etc., depending on what you're trading. So it just sometimes it just doesn't make sense to buy that far out. Whereas if we're buying a contract where we want to bet for maybe a month or two away, we don't want to lose our shirt on that time decay. So I'll buy it out 1 or 2 months away, and then I usually buy it out of the money. So say we're trading Amazon. If I was betting that Amazon's going to go up, I'm probably not going to buy one of these ones so we'll just go zoom out here. How can we get out? Oh, there we go. So say maybe July 12th. So I'm betting Amazon's going to go up. I'm going to go look at probably, I don't know, somewhere around 1800 probably. So about $50 away, probably 1830s. Just because they're just so expensive. So for an 1850, you're going to be paying $3,000 for one contract, but your theta is a lot lower here than the ones we were just looking at in June, right? So it's about a third of the theta, so you're not going to burn down as quickly. And then the delta, when you're out of the money, is a lot lower. So for every dollar move, we're getting a lot smaller of a price increase in the option, but we're also not paying as much for the option premium. So it's a way for us to get more exposure to more companies rather than having to buy 100 shares of each company. You're only having to put up a few grand for each rather than a few tens of thousands of dollars for that. What else do we have? So there's lots of strategies with options. I'm not going to get too much into those. You can do what's called a straddle. So a straddle is buying the options at a set price. So where we're trading right now, so you would do a straddle at either 17.85 or 17.875. You'd buy a put and call in each direction, and in that time, you're hoping that the price of increase is going to go up enough to cover your cost of your other option. And then, so what I did earlier was called a strangle, is where you buy a put and a call at roughly equal distances away from the strike price. And then same kind of theory, is you're hoping to make more money on one side, but you're also protecting yourself on the other side. So so that trade we did earlier, we're actually right on both of them. So we've lost $300 on the puts, and we're down about $25 on the call. So just pretty interesting. So you guys can do this yourself if you open a practice account and play around with it. I'm not a big fan of the Questrade one, because the chart is not real time, so it's a little bit harder to actually practice trading. And then on trading days, the the price isn't real time either, like, or even close to real time. So it's pretty hard to actually learn properly on it. So you might want to just practice with paper trading, or like really small, like SPY contracts or something like that, just to learn. Yeah, and then you can use options to do other things like hedge your portfolio. So if you're very heavy weighted, like if you're long a bunch of the indexes or something, you can buy some puts for SPY, QQQ, etc., just to protect yourself from the downside, and then still remain invested in the market. But watch Justin's hedging video and options video just to get a bit more familiar. This is just kind of teaching you guys how to, like, just the basics of how to read an options chain and stuff like that and what to look for. So in summary, watch the open interest. That's kind of gives you some hints where the price might go. Implied volatility is the expected move and the premium that people are paying for that. So if you go look at something that has earnings or something, it's going to be up in the like 100, 200% volatility, and then after the earnings happen, it drops significantly. So that's why, like, just betting on earnings is not the best, because if you're trying to do a straddle and you have one of each, you're going to lose a lot of theta just based on the volatility and the expected volatility. So it's really hard to make money trading on earnings unless you're right, because you're losing value on both ends. Delta is the change in the option pricing in relation to the stock price, and then theta is your the time premium associated with the stock. Okay, so yeah, just quick basics. If you guys have any questions, feel free to ask me, sorry. And I would just strongly recommend paper trading options, because as you can see, we've lost $300 in the span of about 20 minutes, so that's not the most fun thing to do. Awesome. All right, guys. Well, hope you enjoyed the video, and let's go make some money.